Hello guys, welcome back to my channel. Don't forget to like, comment, share, and subscribe. Crypto trader loves to aid and make diligent investment using high levers in futures market, but most traders fall victim to these three mistakes. Airdrops can also cause discount futures price since the holders of a derivatives contract will not receive the award. But that's not the only case behind a decoupling since each exchange has its own pricing mechanisms and risk. For example, Polkadot quarterly futures on Binance and OKX have been trading at a discount versus DOT price on export exchange. Many traders frequently expressive some relatively large mechanisms about trading cryptocurrencies futures. Especially on derivatives exchange outside the realm of traditional finance, the most common mistake involved futures. Phase and the impact of liquidation of the derivatives instrument. Three simple mistakes and misconceptions that traders should avoid when trading crypto futures. Derivatives contracts differ from spot trading in pricing and trading seriously. The accurate futures open interest in the crypto market surprised $25 billion, and retail traders and experienced funds managers use this instrument to leverage their crypto position. Future contracts and other derivatives are often used to reduce risk of increased exposure and are not really meant to be used for decreased gambling despite the common interpretation. Some difference in pricing and trading are usually missed in crypto derivatives contract. For the reason traders should at least consider this difference when venturing into futures market, even while first derivatives investors from traditional assets are prone to making mistakes. So it's important to understand that existing factory before using leverage. Most crypto trading services do not use US dollars even if they display USD codes. This is a big untold secret and one of pitfalls the derivatives traders face that causes additional risk and disruption when trading and analyzing futures market. The pricing issue is the lack of the transparency, so clients don't really know if the contract has prices stablecoin. However, this should not be major concern considering there is always the intermediaries when using counterparty exchange. These confuters sometimes come with surprise. On September 9, 80 either ITH futures that mature on December 30 are trading for $22 or 1/3%. Below the reference price are spot exchange like Coinbase and Kraken. The difference emerges from the expectation of mass free coins that could arise during the Ethereum merge. Buyers of the derivatives contract will not be awarded any of potentially free coins that the ever holders may receive. Notice how the futures contract traded at 1.5% to 4% discount between May and August. This is backwardation and August, a lack of demand from large buyers. However, considering the long testing trend and the fact the Polkadot rallied 40% from July 26 to August 12, external factors likely in play. The future contract pace has decoupled from the spot exchange, so traders must adjust their targets and other levers whenever using quarterly markets. Higher fees and price decoupling should be considered. The cover benefit of futures contract is leverage our ability to trade amounts that are longer than the initial deposit character or margin. Let's consider a scenario where an investor deposits $100 and buys long $2,000 USD worth of Bitcoin BTC futures using 20x leverage. Even though the trading fees on derivatives contract are usually smaller than spot market, a hypothetical 0.5% free applies to $2,000 trade. Therefore, entering and exiting the position a single time will cost 4, which is equivalent to 4% of initial deposit. That might not sound, but such a toll waits us then for increase. Even if traders understand the additional costs and benefits of using a virtuous instrument, an unknown element trend to present itself only in influence market condition. A decoupling between the derivatives contract and the regular spot exchange is usually caused by liquidation. When a trader collector becomes insufficient to cover the list, The derivative exchange has evolved in mechanisms that causes the position. These liquidation mechanisms might cause drastic price action and consequence decoupling from the index price. Active necessary will then not trigger further liquidation. Unformed investor might risk to price evacuation that only happen in the derivatives contract. To be clear, the derivatives action rely on external pricing resources, usually from a US spot market. To calculate the reinforcing index price, there is nothing wrong with this unique process, but all traders should consider that impact before using reference. Price decoupling, higher price, and liquidation impact should be analyzed with trading in futures market. Maybe that's all from me. Don't forget to like, comment, share, and subscribe.